Hi, everyone. Welcome. Thanks for your patience. Welcome to our latest knowledge series, India's Economic Trajectory, Understanding the Macros for New Age Investing. Um, we've been having a series of knowledge series over the last few months, but it's the first time that Samir and myself are doing one together. So, very excited for this one. We do this because we just want to share our knowledge, share what we've learned being in the market. The idea is to just exchange our thoughts, and then through the Q&A session, really just exchange various ideas as to what's going on in the economy, and just a forum where everyone can learn from. So Samir obviously is co-founder and CFO of hBits. Uh, he's very well poised for this discussion, having spent 33 plus years in banking. Before joining us, he was heading global sales for Nomura, and he's also been at companies like JP Morgan, Bank of America, and UBS. Over and above that, Samir is also a chartered accountant and IIM Ahmedabad graduate. So Samir, over to you to get kick-started, and then I'll jump in whenever necessary.
Sure. Thank you, Shiv. Thank you so much. And good evening, everyone, and welcome to this webinar today. Basically, what I'd like to do today is talk about India's growth story, talk about India's trajectory, see how India has changed over time, and how it's actually come around on its own. I mean, if you were to see India 10 or 15 or even 20 years back, India was really not on the map. But today's India is a very, very different India. And we'll see the statistics of how India has done. Then I also want to talk about different asset classes. We'll talk about equities, we'll talk about debt, we'll talk about commodities. And then I'll pass it on to Shiv to talk about the startup ecosystem and to talk about real estate in India, given the fact that 50% of the people in India own real estate. So that's really the theme for today. So we'll take around 20-25 minutes to talk about it, and then we'll open it up for Q&A. Please feel free to ask any question, and we'll be more than happy to answer that. So let me go through the slides. Next slide, please. So where does really India stand? And after the Modi government has come, I would say 12, almost 13 years back, I mean, things have changed a lot. Whereas you talk about infrastructure, you talk about GDP growth, you talk about just India standing in the world. I think things have changed a lot. And each of the data which I'll go through will actually show you clearly how successful India has been. Next slide, please. So if we talk about global share of GDP, India currently has a GDP of 3.7 trillion and is poised to grow to 5 trillion in 27, becoming the third largest economy in the world. Today, if you see, it's the fifth largest economy, but 27, pretty much everyone is convinced that it's going to be the third largest. And if you see the gap, right? I mean, US obviously is the largest with 28 trillion, China at 18 trillion. I think it's India's growth story for the next decade or even beyond that. And I think the growth, I mean, today India grows close to 7%. None of the countries globally are growing at that. So I do feel that India will catch up with China very quickly. And of course, US is a very, very large economy. But definitely, I wouldn't be surprised if India becomes the second largest economy in maybe 20, 25, 30 years. One very interesting statistic, it has been a domestic economy. In fact, today, 60% of what India produces is actually consumed within the country. If you look back, probably 30, 40 years back, it was almost 80 to 85% which was consumed domestically. Things have changed. I think the exports are picking up, imports are picking up, and definitely India's entered the global stage. Next slide, please. India is the fastest growing economy in the world. However, India's share of wealth is very small. It's still less than 3.5% of global wealth. And a lot of the wealth actually has grown, I would say, in the last 10 years. with equities doing really well, I do expect this wealth to actually grow substantially. Services exports are rising to 450 billion a year. And with large organizations moving to India, we do see this wealth effect definitely growing and catching up with the rest of the world. Next slide, please. Market capitalization, we spoke about that. It's despite being the fifth largest country by market cap, India's weightage in global indices is very, very small. It's still at 10%. It's still at 10th, almost only 1.6%. And now this really happens because of liquidity, because it's not been marketed well. We've had a lot of issues in the past, but recently we got included in the emerging market bond index. Now that obviously will see a lot of flows. I think what this government has really done well is marketed India so that more and more foreigners start putting in capital into the country. And I think that's really, really going to grow. Next slide, please. So when we talk about India market performance and global market performance, this is a slide I love called the Fear and Greed Index. This is actually presented typically by CNN, where the index actually looks at what the market momentum is, what the stock price strength is, what the stock price breadth is, how many buyers, how many sellers, what's the market volatility, what's the safe haven demand, stock versus the bond performance, junk bond demand, and the put and call options. I mean, I urge everyone to follow this index regularly because this will then advise you whether you should be going long or you should be neutral or you should be going short the index. If you look at the last year's trajectory, every time the index has gone above 75, it's in what we call the extreme greed range. It's actually fallen quite a bit. In fact, if you see in April 23, it fell all the way from 75, almost 70 to 25. In July, it again peaked at 70, 75. In October, it fell all the way to even less than 25. Today, the greed index is trading at extreme greed. It's trading at 79. I do expect it to correct. I'm not saying it's going to correct to 25, where there is extreme fear, because overall the market seems to have a lot of capital on the sidelines. But definitely it will correct. So do keep this in mind when you are investing in different asset classes. And we'll see in the next few slides how actually the markets have done. Next slide, please. So this is how, if you see how the indices have done, India, of course, Jan has been extremely good. Nifty is up close to 2%. In the US also, the NASDAQ 100 was up 3.6. In fact, at Feb, it's even gone up further. It's up to close to 7%. So most of the indices have actually done very, very well, except for China. And overall, given the political stability in India, in fact, this government is expected to actually come back once the elections are held. Definitely, the trajectory is going upwards. But I do feel that you should keep in mind what I've said earlier around the greed index. Follow that. That's actually a publicly listed index. If you just type in fear and greed index, CNN shows you very clearly where the index is. Definitely keep looking at it before you take any steps around different asset classes. Next slide, please. The India growth sectors for the year, obviously, pharma has done very well. All the public sector banks have done well. The infrastructure has done extremely well. Energy has done well, at least for now. Some of the areas which have not done well are financial services. The banks have been under pressure and they've actually not done too well. FMCG hasn't done well. But overall, if you see, pretty much wherever there was capex involved or wherever there was infra build involved, those have actually done very, very well so far. Next slide, please. Performance of commodities. I mean, I wouldn't say commodities have done particularly well. And people who heard my webinar 3-4 months back, I did mention that gold I don't really see it going up that much. And commodities, I actually don't see them performing very strongly this year. Crude oil, I do think could bounce back as demand starts picking up. Crude may actually bounce back, or if there's any more conflict in the Middle East, that could happen. But other than that, I don't see commodities performing major in a big way. Next slide. India's some statistics. India's forward PE, despite markets being all high, continue to be at a 5-year average PE level. Although it's an election year, judging by the word on the street, continuation and political stability continues. Everyone is betting that this government actually comes back. As I mentioned, 50% of Indian wealth is in real estate and rest in gold, which are the two most preferred sectors. I don't see gold performing this year, so one could actually switch on real estate. Obviously, we'll talk a bit about real estate, and I will let Shiv take the lead on that. But definitely switching from gold into some of the other asset classes definitely makes a lot more sense. Next slide, please. Let's talk about some of the indicators for India. The debt equity story, fantastic. I mean, the leverage is at 15-year low. It's amazing how corporate leverage in India continues to come down as companies to do a lot better. I'm fairly confident that I do not see leverage going up, at least for the next few years, which is extremely positive for corporates in India. Next slide, please. Banking reforms. I honestly do feel RBI, our central bank, is probably the best central bank. I mean, having worked overseas for 35 years, having monitored a lot of the central banks, I think RBI does the most amazing job, which is one of the reasons, if you see also the way they operate in India, the NPA ratio of the banks is also at all-time lows. They're always keeping a keen eye on some of these things. And I think banks are doing an extremely good job around managing their NPAs. Also, this clearly shows, obviously, that the economy is doing really well, right? Typically, when growth is doing well, when people are doing well, NPAs are obviously low. And this, I continue to feel, will continue to come down as India's growth story continues. Next slide, please. New age investors, we're getting a lot of younger generation. India's increase in population, as you can see, in the 30 to 60, in fact, around the 30-32 area is growing. And they have started investing, which is one of the reasons you see so much SIPs happening in mutual funds, investment in real estate growing. So definitely a lot of the younger generation is also driving growth for India. Next slide, please. We spoke about this. Credit as a percentage of GDP is extremely low for India. And these indicators are very good in basically saying that the stability of the country becomes very important then. And India typically has never taken credit. I mean, the savings rate is one of the highest in India. So definitely it's an amazing story. Next slide, please. Equity holdings, I guess everyone knows this story. But look at it, only equities as a percentage of household assets is only 4.7%, which is the reason I feel this again will continue to grow. Equities, alternative assets will definitely continue to grow. And it's at 4.7% despite the number of SIP accounts increasing, SIP contribution increasing. So a lot of the historically where people have held assets like gold, I think a lot of that is actually going to move into more of alternate assets and equities. Next slide, please. So this, in a nutshell, is what the Indian households own. Property is 50%, cash, of course. Gold is a very large proportion. A lot of the senior people hold bank deposits and, of course, insurance and pension funds. So as you see, 66% of the Indian wealth is in real estate and gold. The two most preferred sectors. And with GDP and wealth growing, more inflow can be expected, especially, I think, into property and alternative assets. I do think that's going to happen. Next slide, please. So let's, this, I won't spend too much time on this, but as we've seen, Fed has been very hawkish over the past couple of years. And now, obviously, with inflation coming off, rates are expected to be cut. I honestly feel rates will start getting cut in July onwards. And typically, Fed should be cutting interest rates by at least 3 or 4 times, if not more. So definitely, inflation coming off has helped the Fed's agenda. And I think that's going to continue to come off. Next slide, please. India's inflation story, pretty much like the US, inflation continues to come off. It's pretty much at getting very, very close to the RBI's medium-term target of 4%. And hence, I feel once the Fed starts cutting in July, you will actually see RBI also starting to cut rates. Plus, with the government being formed around May, June, July, this could be an amazing, amazing next 3 to 5 years for India. Next slide, please. We spoke about this. Next slide. So let me now pass it on to Shiv to talk about the startup story in India, and then also to talk about real estate. Over to you, Shiv.
No, thanks for that, Samir. I think you've given us a good overview of the macro environment where India stands with the rest of the world, as well as the where commodities, where equities are, and but I think the one takeaway from what you mentioned, and which I'll probably have a similar thing in the next few slides, is that India's done extremely well in the last few years, and I think we can expect the same. And it's pretty much the same in the startup ecosystem, right? I mean, if you just look at this chart on the right, I think there were barely any unicorns in 2011 to over 111 in the last 10, 12 years. I mean, that's just a phenomenal story. And, while India might be the third largest in terms of the unicorns behind US and China, I don't think this level of growth in the last few years would have been seen anywhere across the world. And I think that speaks a lot to, one, the Indian entrepreneurial spirit, and then as well as the ecosystem being matured. I think the last 10 years were, in a sense, the childhood and teenage years of the startup ecosystem. And now it's entering the adolescent phase. Sure, 2023 has been a little bit tough on the startup ecosystem. We have seen a funding drop from 2022 and 2021. But I think that's a very positive thing, because now capital is not just chasing growth, it's chasing profitable growth. And that's the sign of an ecosystem maturing. And we'll see more of the same going ahead. There is a lot of dry powder. VCs do have a lot of money to invest. There are not that many options to invest in. So the money is there. I think now VCs have realized they need to chase profitable growth. And we will see this number go even further up in the years to come. So that's a bit on the startup ecosystem. Next slide, please. So a little bit on the real estate sector. And broadly, I'll be talking about the two aspects, the two pillars of real estate, residential and office real estate. So next slide. So firstly, on the office real estate market, I think we've seen some tremendous absorption trends. The last 2023 was 65 million square feet of absorption, which is over 2019 levels. I think there was an uncertainty in India post-COVID as to what's going to happen to office real estate. But I think that uncertainty is completely vanished. I think there's clear certainty that in India, at least, it's a complete work from office play. In fact, what's happened is that a lot of the GCCs, or global capability centers, of US headquartered companies have seen a tremendous uptick in India. So just to what that means a little bit is that given COVID, and given that US corporates saw that the business could continue without employees being on site, so now they've outsourced all that work to Indian tech companies. So the outsourcing to India has increased tremendously. And across the top 6 cities, Mumbai is 90% back to office. The lowest, Bangalore, is also at 75% back to office. I think TCS recently announced that it wants its employees to be back to office by March 31st. And that's seeing an uptrend in rentals. Next slide, please. And we've seen vacancy levels at good levels. It's about 15%, which is generally structurally, building 10 to 15% is normal. And what's going to happen in the next few years is that given there was uncertainty in commercial real estate in 2021, there was no new supply coming up. And so over the next 3-4 years, real estate supply takes a while to build up. So the next 3-4 years, as demand continues, as outsourcing to India, that trend continues. As the rupee depreciates against the dollar, so the dollar against the rupee is also a very different important metric to track. Global headquarters company look at a dollar per square feet rate. So as long as the rupee is depreciating against the dollar, real estate in India becomes cheaper and cheaper for global companies, and global companies occupy 70 to 80% of real estate in India. So I think we're going to see a tremendous capital appreciation and rental uptrend across markets in India. Obviously, one has to look at specific micro markets to take an educated view on that. Next slide, please. And then we see residential, right? The mortgage percentage as a percentage of GDP is tiny. It's at the lowest. It's at 11%. And just backtracking a bit, what happened to the residential real estate sector? So I think that the 2010 to 2020 overall was relatively slow for the residential sector. It had kind of stagnated. Prices had stagnated, transactions volumes had dropped, but that changed post-COVID. The interest rate environment dropping, and potential home buyers deciding that they do want their own home and they don't want to rent, and them realizing that given what's happening in the world, I think the market is not going to get any worse than it was in 20 and 21, and then that injected that was a huge catalyst for the residential real estate sector. And the volume of transactions, prices across top 6 cities and second-tier cities have just accelerated. And what this graph shows is that given debt is so low, there is potential for homeowners to level up a bit more and see more potential in the residential sector as well. Next slide. And looking at that from a macro level, what does that mean for the real estate sector? If you look at the graph, PE and VC investments in real estate in India from global institutions have been a robust $3 to $6 million a year. That's an extremely large amount. And what we're seeing now is that is supplemented by domestic capital that's chasing Indian real estate, specifically commercial real estate, as an investment option. So while domestic capital has entered, there was recently a transaction, Blackstone exited and Bain Capital has bought in a share in REITs. And now we have domestic capital chasing these asset classes as well. And the left graph, you can see just the 5x multiple from 2030 to 2047 in the size of the Indian real estate market. So overall, I think a lot of positivity, whether it's startups, real estate, equity, bonds, overall, I think in a growing economy, where the basic structural state of the Indian economy is positive, I think it's an upward trend. So that's it, Samir. Anything for you to add? Closing remarks?
No, just a few closing remarks. As Shiv said, all the asset classes are looking very, very good. But obviously, when to invest, timing-wise, you've got to be obviously careful. As the fear and greed index talks about, especially in equities, that it's extreme greed right now. So you just need to be sensitive around these things. But if you're looking at a 5 or 7 year view, I think it's going to be amazing. So it is India's story. The trajectory is looking really, really good. And I would say the next 10 years or even more definitely belong to India, pretty much across all asset classes. So thank you for that. And we'll now open it up for Q&A.
So Samir, there's a question: will fractional ownership expand in tier 2 and tier 3 cities, considering the liquidity and trust aspects of real estate and mentality of people having full ownership in their investment? So great question. And I'll give, I think this is a slightly nuanced question, which I'd like to give. So firstly, mentality of people having full ownership of their investment, I think that's rapidly changing. Now that SEBI is regulating this industry, the comfort level of investors is changing in tier one cities and in tier two cities. In fact, 20% of our investors come from tier two cities, whether it's Baroda, Surat, Indore, Jaipur, Mangalore. They've invested in tier one cities, but the investors are from tier two cities, and that market is just growing. We have our team traveling to Lucknow, to Indore to meet people as well. So that interest is there. In terms of assets, looking at assets and properties in tier two and tier three cities, I think, what has to happen is that the office market in these tier two and tier three cities, I think, needs to be established a little bit. So I think GIFT City, if we count Ahmedabad as a tier two city, could be a tier one, could be a tier two city. But I think the hubs for office market has to be established. So far, I think real concentration of offices, and professional workers have primarily been Mumbai, Pune, Bangalore, Hyderabad, Chennai. But at some point, I think we require other cities to develop as well. But other asset classes, right? Whether it's warehouses, I mean, every tier two city needs warehouses with e-commerce boom, and there's a huge consumption story. Malls, retail is extremely robust in tier two cities. Hospitals, schools, I mean, that's required everywhere. So those kind of fractional ownership, I think there is an immediate opportunity for assets to come up. There's a question from Yashwant: Japanese property in Bangalore to be discussed. So Yashwant, that's I won't talk too much about that property in this presentation. We had a separate webinar earlier this week where we launched the property. You can access that on YouTube, or you can get in touch with your RM. But just 3 points on that property. We've never had such a good property in our portfolio. It's the best tenant that we've had. Toyota. It's the 30th largest. It's within the 30 largest companies in the world. It's in the center heart of Bangalore, so you can't get a better location. And the price that we're getting it at is a steal. But that's what I'll talk about. It's filling fast. In 5 days, or rather 4 days of launch, we're already 15%, or I think now 20% funded. There's a question from Tasneem. What is better for commercial real estate, office spaces or storefront shops for retail? See, I think they're both very good investments, and ultimately one has to look at the capital value, the tenant profile, the lock-in, the quality of the building, the location. But high level, office spaces tend to give you 8 to 9% rental yield, while retail tends to give you 5 to 6% rental yield. So overall, office space tends to deliver a higher return than storefront shops. So that's kind of the difference. Question from Mohammed: how does a client safeguard his investment? So I presume this is in relation to fractional ownership. So the investment is completely secure. The investor owns shares and CCDs in a private limited company that owns the asset. Diligence is done by a tier one law firm, in our case, Shardul Amarchand Mangaldas. So you ultimately are the owner of the asset. We are just the manager. Samir, question from Karthik. Maybe you could answer this one. Best assets in India and where to invest in the long-term perspective.
Sure. So if you look at the best asset classes, I would say equities is one asset class. I think over long periods of time, equities will give you anything between 13 to 15%. And this I'm talking about index large cap names. I think commercial real estate, and since I've been now very, very involved, close to 2 years, will probably can give you 15 to 16% returns in terms of asset class. If you're looking to debt typically you should not expect more than 7 to 8% returns. Gold, I would say anything between 5 and 7%. If you see residential as an asset, on an average 3 to 5% over long periods of time. So I would still say equities and commercial assets. And when I say commercial assets, it could be office buildings, it could be warehouses, it could be data centers. These two asset classes, if you ask me, are probably the best, where you can expect any returns, any returns from anything between 13% to 16% over long periods of time.
Great. Samir, I think next question for you as well. Impact of recession news in UK and Japan. and what impact that'll have in India, specifically the exports?
No, I think almost zero impact. In fact, Japan has actually come off quite well. UK, yes, there is news around the UK slowing down. Honestly, for India, firstly, as I mentioned in one of my slides, 60 to 65% is domestic consumption. And broadly, I mean, we haven't even scratched the export market, especially to countries like the US. So I do not see any impact of this news on India at all.
Great. Question on typical holding period for fractional commercial assets. 5 years generally, 5-6 years is what we look to hold, because that's when the appreciation kicks in. Fractional ownership platform coming under regulation of SEBI. Yes, I think SEBI's come up with the MSM REIT framework. We're expecting the notification at any point in time. And as we've announced before, we look to be the first platform to migrate to the new structure. How liquid are your offerings? So we'd like people to stay for the long term, because that's when appreciation kicks in. But some people have had emergencies. They wanted to exit within a year of investing, and within 30 to 45 days, we've given an exit to investors. Question from Mahesh: 13% in real estate, seriously, in fractional ownership? Absolutely. We've given an exit at 17% IRR already. Overall in commercial real estate, you look at the IRRs that Blackstone, Brookfield have made in the last 10 years. They are in this range. Another property we acquired, for instance, 3 years ago, we acquired at 11,600 rupees per square feet. There have been transactions in that building at 15,000-16,000 rupees per square feet. So, it's a combination of rental income and appreciation. Your rental income is 8 to 9%, appreciation anywhere from 5 to 7%. And I think that's why we're very positive on this.
Any other questions for us? So if not, thank you so much for joining this webinar. We will continue to hold this knowledge series on a regular basis and continue to give whatever knowledge we have. Sorry.
There's one question I want to answer because it was just asked.
Oh, okay.
So will REIT companies come into fractional ownership business? So if you look at all the traditional REITs, they are effectively developers, and they have liquidated their own assets. So for them, the REIT platform has been an opportunity for them to sell their own properties. While fractional ownership players are picking up third-party properties. So for REIT companies, they're not going to get into fractional ownership. They are focused on, creating their own assets, developing it, and exiting to REITs. I think fractional ownership players are selecting between multiple third-party assets to bring onto the platform. And I think, Samir, a few more questions. So let's just maybe answer those. With the startup ecosystem on slowdown, will there be higher vacancy for office buildings? So I think the startup, generally the startup ecosystem has not been occupying kind of the grade A offices. 70 to 80% of grade A offices are anyways occupied by the likes of, whether it's Accenture, IBM, Deloitte, Infosys, TCS. So really not too much of an impact on the vacancy because of, this hiccup in the startup world. Question: returns on commercial RE on market value or invested value? So returns are obviously calculated on the amount that has been invested by the investor. So yes, Samir, I think that's those are all the questions now.
Please send YouTube link. Yes, Neeraj, you will be sent the YouTube link. Absolutely. But thank you so much again, and we will continue to do and have this knowledge series on a regular basis. Thank you for joining today. Thank you.
Thank you, everyone.